Okay. Okay, welcome everybody to the Kushner Report for January of 2026 for the first quarter of the year. And at the end of our presentation today, we'll have a chance to participate in our Q&A session. And today we have a guest. Kathy Clark is a mogul in the real estate business in Orange County, and Kathy's going to give us some insight on what she sees happening in the marketplace. So we're really excited to go forward with that. So today's agenda, we're going to take a look at the key economic indicators, the global economy, the domestic economy, mergers and acquisitions, and other significant economic news. And today we're going to take a look at the U.S. economy and underlying assumptions, and then we'll take an overview of residential and commercial real estate. So first of all, the real GDP growth for this year is somewhat modest, not booming, and many baseline forecasts are seeing that the U.S. is avoiding a deep recession and really settling into moderate growth as we progress through the year after a bumpy 2025. The GDP this year is projected early on to go out somewhere between 1.8 and 2.6%. Inflation continues to drift down. However, several outlooks expect inflation pressures from tariffs and policy to fade over 2026, but the target for the Federal Reserve is still to be around 2.6%, around 2% target going forward. Interest rates, as you know, they see shallow easing, not a return to zero. And economists believe that we expect the Federal Reserve to drop rates a couple of times during the year. They met yesterday, and the decisions are going to hold off until the month of March, to decide the next step with interest rates. And policy uncertainty is fading away, which is good news. The tariffs and early policy shocks that weighed on the economy in 2025, we should see growth and focus on reducing inflation going forward. In financial conditions, basically, it's neither tight nor very loose, but modest rate cuts are still cautious by the Fed. And financial conditions are expected somewhat to be a lot easier than they were a couple of years ago when we saw interest rates going up and escalating. On a global basis, it's going to be sturdy but not spectacular. And I guess global real growth is going to be somewhere in the high twos going forward. And this is basically the common assumptions now early in January. The good news here is in the AI and semiconductor and cloud industry, AI data centers and relative infrastructure are expected to remain a key investment engine during the year. And trade tariffs and reconfiguration of supply chains, we're going to see ongoing tensions continuing throughout the world. However, the good news is we're going to see more onshoring taking place in the United States. So you're going to see more companies coming back to do manufacturing and so forth in the United States. So this will help infrastructure, and it also help manufacturing as well. In the technology space, demand has continued to be one of the strongest areas in the economy. In AI infrastructure, data centers and networking, cloud modernization, software that augments productivity are really expected to grow faster than overall GDP. In the area of pricing power, we're seeing relatively high for differentiated AI hardware, leading cloud platforms and critical software, and more commoditized IT services. We may see and feel the price of pressure in the pricing area if we don't see growth and growth softens as we go through the year. However, there are risks, and the major risk right now is about regulatory scrutiny, AI, antitrust, and data privacy. These are the engines drawing a lot of the concerns on the other side of the platform. When we look at demand in the industrial side, it's moderate and uneven. We're seeing, again, as I said earlier, a lot of nearshoring with infrastructure spending on AI data centers and build-outs, and defense and cyber needs to support certain subsectors, such as automation, robotics, power equipment, industrial software, and specialized materials. Again, still have a weak manufacturing sector, and it's still in contraction. In the area of biotechnology, the U.S. biotech market continues to be strong, projected to expand substantially as we see part of a long-term trend driving towards more innovation, healthcare demand, and investments in new technology, especially in the area of AI. In the energy cycle, we're seeing that oil prices are expected to soften because global inventories are rising faster than the demand. And this is going to keep benchmarks more like the Brent around the $55 a barrel throughout most of the year. And economists suggest that we have a continuing oversupply of oil, which may have a pressure on pricing going through the year. When we look at renewables, strong driven by policy incentives and corporate targets, and physical needs such as grid reinforcement, interconnects for data centers, and of course, electronic vehicle charging, along with distributed solar. So in pricing, it's moderate, and tech advances are going to push prices down and costs down. So this is good news going forward in the year. In the area of healthcare and pharma and life sciences, we're seeing demand continue. We're structurally solid and relatively insulated from what we'd call moderate economic swings, and it's underpinned by aging, demographics, and chronic conditions. In the area of pricing, it's somewhat mixed. Innovative therapies and specialized equipment prices will retain their pricing power going forward. Commoditized drugs and services are facing cost and reimbursement pressures across the board, as you can see with what's taking place in the insurance industry. And AI is expected to accelerate drug discovery, diagnostics, and operational efficiency, which can create winners in a data-rich subsector, reducing costs across the board. In the area of financials, still pressured by rate cuts, but supported by still positive real rates. And in terms of quality of credit, somewhat deteriorating as we go forward. I'll talk more about that later. In the area of capital markets, M&A has been strong for the last 3 years. We expect that to even improve going forward in 2026. Infrastructure, the outlook here is broad, driven by multi-year federal and state programs such as transportation, broadband, energy, and water. The beneficiaries in this particular area are going to be great. It's going to really involve engineering construction firms will be the greatest winners here, especially with equipment rental and certain industrial software and controls. In many cases, we'll see, for example, the biggest concern we have, especially in California, is about permitting delays, labor shortages in construction trades, and cost overruns. So those are two areas that are really suffering right now, and we hope to see improvement later in the year. So in summary, what's happening is we have a stable but moderate growth rate for GDP, somewhere between 1.8 to 6 growth rate, and inflation will continue to moderate, but remains above the target of 2%. The labor market continues to soften with moderate increases in unemployment, and the Fed is easing monetary policy, but however, very slowly. AI and tech investments will boost activity across the country and across the world, and tariffs and policy frameworks will persist, influencing prices and trade. Global economic conditions remain somewhat mixed but supportive, and of course, risks of a recession or inflation spikes are present, but they're not dominant, so we're not looking to go into a recession. So that kind of gives you a snapshot of where we look in terms of the economy and underlying assumptions. Now let's take a brief overview of 2026 residential real estate outlook. So first of all, the growth is supposed to be modest. We're seeing a modest appreciation. Experts generally expect slow, modest prices going up, not a crash, but lower than normal. So what we're seeing right now is the modest gains are expected to be somewhere in the 2 to 4% range across the country. Mortgage rates continue to stay elevated, somewhere between 6 and 6.5% throughout much of the year. They could see a decline later in the year. And there are some forecasts that talked about greater activity taking place further in the year. Affordability may improve modestly as wages grow faster than home prices grow in some areas of the country. The impact basically is high interest rates have continued to dampen buying activity, particularly for first-time buyers, but slightly easing as we unlock more demand later in the year. As of a study that was just done that said there are 48% more sellers in the market than buyers. Housing inventories are expected to increase modestly throughout the year, given more buyer options. And then the sales volume is expected to grow as well, somewhere between 2.5 and 5% throughout the year, still lower than historical averages that we've seen in the past. Builders, again, single family starts and residential construction may tick up, but it still lags behind the market need in the area. When we look at the regional segment, the luxury and affluent segments remain very strong, stronger than the entry-level housing market due to low sensitivity among wealthy buyers. And in terms of regional differences with significant but somewhat growth markets, where examples such as the Midwest and Northwest will be stronger, and we may see demand cooling in the Sunbelt markets. So Sunbelt markets would consider like states of California, Arizona, New Mexico, Oklahoma, etc. In summary, 2026 is expected to be a moderate, balanced market with slow price growth, more listings, slightly higher sales, and persistent affordability challenges. It's not a boom year, but it's going to be better than we've seen in the last 2 or 3 years. So this is good news in the real estate market at this point. Now let's take a look at the commercial real estate market. So there's multiple feelings that we're going to see a lot of improved confidence and improved marketability and fundamentals in the year of 2026. So capital markets are re-engaging with lending volumes rising, debt costs easing relative to peak stress periods. And institutional investors are returning to the market, and transactional activity is increasing. We see business segments remain cautiously optimistic that fundamentals like rental rates and lease activity will improve in 2026. From a data standpoint, it's driven by AI boom. This is the top-rated sector for growth during the year, expecting to see growth of over 19% for demand. In the industrials, the resilience and the vacancy rate is around 7.6% as more manufacturing is taking shape and moving onshore, with the demand for specialized facilities. And the retail area is coming back. It's showing so resilience with tight supply and discipline development, and we're seeing modest growth of about 1.5%. So that's good news on the retail side. Now, when we look at commercial mortgages, we're now what's called hitting the maturity wall. Approximately $1.8 trillion in commercial mortgages are set to mature this year, forcing many owners to refinance at higher rates than their original loans. This may trigger a wave of restructurings and distress sales for underperforming assets. And one of the surveys was done recently that there'll be further stabilization in 2026. Nearly 70% of commercial and real estate experts believe activity will rise during the year. So commercial and multifamily lending volumes are projected to rebound. So in general, the commercial real estate market outlook for the year is transitioning from stress toward measuring recovery with improving liquidity, selective investment confidence, and sector-specific growth opportunities, though weakness persists in some markets. Overall, I think we're looking at somewhere around 2030 before the market really comes back to what we've seen in the past. So that's kind of what we see in the commercial marketplace going forward. So this is all good news moving forward. Now let's take a look at our key market indicators. We're going to look at the gross domestic product, inflation, unemployment at the federal level, the California level, and then we're going to take a look at the price per barrel of oil. So these are the early indicators for the year. And again, these are going to change throughout the year. We still don't have really firm final numbers for 2025, but this is what we have to date. So the full year 2025 forecast for global GDP looks like it went out around 3.1%, and they're looking at a target of 3% next year. And the federal, our reserve is going out somewhere as GDP is around 2%. I think that's going to increase after when I tell you what happened in the third quarter of this year. And then next year, we're looking at GDP for 2026 of 2.5%. Inflation is looking more or less along the lines of 3.1% overall, dropping down a little bit to 3%. And that may drop even further as we get through the latter part of the year. The unemployment rate nationally is around 4.4% in December, and unemployment is projected to increase to about 4.5% during the year. California, which suffers the most and has the highest unemployment in the country, it ran at 5.5% closing out December, and we're looking at unemployment during the year around 6%, and that will start coming down later in the year. But those numbers are substantially higher than the national average. Price per barrel of oil is West Texas Intermediate. The range is between $60 and $65 a barrel, and that's because we have a surplus of oil around the world. That could change if anything happens later in the year. So let's take a look at the global economy, some snapshots. So first of all, the Eurozone, the growth is expected to be modest. We look at fiscal infrastructure as supporting activity while consumer income gains will help demand across the board. What's interesting is Germany, which is the largest economy, is showing cautious optimism, while fiscal easing and investment could lift activity later in the year. So this is very strong because they're the leader in Europe. There's cooling taking place. We've seen global inflation data this week was largely significant and signaling the easing with declines in the Eurozone, Sweden, Australia, and Mexico. However, Switzerland, Norway, and China saw modest temporary increases in inflation. Japan again contracted in the third quarter. Their economy continues to struggle. And to that point, what they did is they raised interest rates by 25 basis points. Now let's look at the domestic economy. So as I mentioned earlier, a couple of things. Number one, we saw where the third quarter GDP grew at sort of 4.4%, which is incredible. We haven't seen that level of growth in a long time. That should have an impact, hopefully a positive on the fourth quarter of last year, and then raising the rate that we saw this year, going out and possibly increasing the rate for next year. So what's interesting is the fact that what we saw is inflation did tick up. We saw government spending, uh, commercial spending, imports falling, and inflation ticked up slightly. But we did see corporate profits increase by $166 billion last year, which is a phenomenal number. As you know, in December, the Federal Open Market Committee met and they dropped interest rates by 25 basis points. So the current range is between 3.5 and 3.75%, which is signaling additional cuts will take place during the year. The meeting was held yesterday, and my understanding is that the rates will be held the same. They'll revisit this in March, later in March. But we expect to see two or three rate cuts take place throughout 2026 unless the economy turns south. Credit card debt, again, this is a real concern. It's at now at $1.21 trillion, closing out an all-time high over from 2024. The biggest concern we have are delinquency rates for credit cards, which is now just under 7%. And in the area of U.S. bankruptcies, well, first of all, let's talk about the farmers. So the farmers had a great year, and they're on solid ground. What we're seeing here is the agriculture sector is riding tailwinds of sturdy income growth and moderating production costs. And strong receipts for livestock are really boomed by the nation's ranchers who are highly reliant on cattle as a source of cash flow. So this is strong now in that marketplace. When we look at the area of U.S. bankruptcies, again, they rose. I'm going to talk more about that later. They're the highest level since the COVID began. Now let's take a look at inflation. As I mentioned earlier, inflation was up a little bit. We saw price pressures from groceries, dining out, utility, gas, clothing, and other categories of consumer spending. So the index was around 2.7%, possibly relocated a little higher to around 3. We'll know that in a couple of months. Wholesale inflation increased by 0.4 of a point in November. The numbers for December were not available at this time. And in the area of retail sales, we saw moderate growth of about 0.4 of a point in December. Now let's take a look at the employment picture. So in December, we had a modest 50,000 jobs created, and the unemployment rate decreased to 4.4%. And if you look at it by sector, it was somewhat, we only had four areas in the economy that really grew, and that was government, financial services, health and education, leisure and hospitality. All the other sectors suffered losses, and I'll talk about that later in the presentation. I mentioned the unemployment rate. There were approximately 7.1 million job openings in December across the country. However, most of these jobs are on hold to determine what companies are going to do with their budgeting and planning as we move into 2026. And one factor that did come out, which is of concern, is the fact that in the U.S. we have 5.5 million employees underemployed. That means they're part-time or they're working two jobs. That is pretty significant. Now let's take a look at California. So when we look at the California market, there were 32,000 jobs created in December. The unemployment rate decreased to 5.5%. I said 5.5%. The December breakdown categorically from Beacon Economics is not available. That was due to the government shutdown as well as the loss of a lot of jobs in the economy, in the government. So we'll have better data going forward. But in September, the overall number for jobs is 4,500. And you can kind of take a look at the categories here where they were. Essentially, there was not a lot of activity that took place. Now, getting back to our other economic indicators, inflation, again, as I mentioned earlier, was interesting. But When we look at interest rates again are holding. Again, we dropped it by 25 basis points. Expectations are we're going to see more rate cuts going forward, possibly three for the year, taking it down maybe 0.75, which would be good news. So the economy is strong. And should improve further as we go further in the year. Mortgage rates decreased a little bit last month. The average across the board is 6.09% as we are closing January. Again, that's the average interest rate, not depending upon what you're doing, but across the board. The manufacturing index, unfortunately, the PML fell again to 47.9, and this is the 10th consecutive month we've seen of contraction. As I've mentioned many times, a reading below 50 represents contraction. In the area of small business confidence level, it inched up to 99.5, just under the 100, and it remains 52 years ahead of the average of the 98. So it's been very good. The 52-year average has been very, very good. In the area of consumer confidence, we saw a downturn of to about 3.8 points, and a lot of concerns about what's happening going forward. The crude oil prices, as I mentioned earlier, this morning they're up at $62.15 for the price of West Texas Intermediary. That's up since the $58 that we saw in December. Again, the vacillation is taking place between $60 and $65 a barrel. And again, that's because of oversupply in the marketplace. In the area of housing starts, we saw housing starts decrease month over month by 4.9%, 4.59%. And there was a decline in that whole area of starts. Some of that was weather driven, among other issues. New home sales increased by 3.6% in the month of December. That's a good month for us. And when we look at Southern California, I'm going to take a look at three particular areas. So first of all, in Los Angeles, the average price on the market dropped to $891,000. That's a decrease of 5.5%. The good news is sales for the month were up by over 20% from November, and sales increased by 0.9 of a point over December of 2024, moving in the right direction. Orange County, the midpoint was 1,390,000. That was a decrease of 0.7 of a point, but sales were up by 7.5% from November and up 2.4% from December of 2024. San Diego, the price for the inventory on board now is now back at $1 million a unit, and that's up 7.4% in December. Sales were up by 2.6% in December and up about 0.6 of a point over December 2024. Good news in the existing home sales, they were up by 5.1% in December. So overall, things were looking good in the month of December for real estate across the board. Now, productivity, which is a real key indicator for our economy, had a stellar performance in the third quarter. We saw non-farm labor productivity increase by 4.9%, which was substantial. And then the output was up by 5.4%. So this is very good for the economy going forward. The one area that's of concern, it's always a concern, is called what I call the area of company displacements. I've got many, many companies over the last 3 months have had major layoffs, and I only look at those that have laid off over 1,000. So just to cover a few of these, number one, UPS, United Parcel Post, 48,000. Paramount in the studios business, 2,000. Estee Lauder, 7,000. IBM, 2,700. Verizon, 15,000. Hewlett Packard, another 6,000. Omicron, which is a Bay Area entertainment and media company, 4,000. And then Kroger, who's in the market business for supermarkets, closed a number of stores around the country, and they laid off 9,000 people. Now, the M&A space, again, a very, very successful active market over the last 2 years, and we're going to see that going forward as well. A lot of consolidation taking places in different vertical markets, in biotech and energy, restaurants, etc. So, first of all, Novartis is active again. They're acquiring Avidya for $12 billion. This is a company involved in therapeutics for treating debilitating diseases. Denny's, if you're familiar with, has been bought by a private equity group for $620 million. The intent is to restructure the business, close non-performing stores, and change and hopefully improve the menu. And then we look at Eaton Corporation, which is very active again. It bought a thermal company Boyd Thermal in the data center play. And this is a $9.5 billion deal. This is to capitalize on heavy demand related to artificial intelligence data centers. And then Kimberly Clark is acquiring Kenvue for $48.7 billion. Kenvue is the world's largest pure play player of consumer health company. What they do is they offer brands such as Tylenol, Neutrogena, Listerine, Aveeno, and Band-Aids. So you're seeing that taking place. When we look at Aquarian Capital, they're acquiring Bright House Financial, and this is a major play in a company strategy in the insurance and asset management business. So this is another major area here of strengthening a vertical market. And then Core Mining is acquiring New Gold in an all-stock deal for $7 billion. So New Gold is a Canadian-based mining company focused on exploration, development, and production of gold, copper, and silver with core operations in Ontario and all over Canada. And it's being bought by a U.S. company. So this is important to us as you know what's going on around the world with precious metals. And we're falling further behind the Chinese. Merck is acquiring Cidar Therapeutics. Basically, it's another biotech technology consolidation for $9.2 billion. And then Adobe is active again. They're buying SEMrush to expand their brand visibility tools for $1.9 billion. California Pizza Kitchen, which has been around for a long time, has been acquired by a company, and the idea is to take the casual dining room and restructure it and come back with a new era of growth. So there's another restaurant chain that's going to go through major changes. Constellation is buying Houston's largest private company, Calpine, and the agreement creates the nation's largest clean energy provider in the country. Netflix, you may be aware of, has announced a deal to buy Warner Brothers film and streaming assets for $72 billion. And we'll see what that if that is able to take place. And then we have IBM is active again. They bought a company called Fluent, and Confluent is valued at about $11 billion. Their most capable stock, basically technology, is to unlock real-time value of data. And Apex is acquiring a company in the marketplace called Yada 2 for $950 million. That's an Israeli-based group, and it was formerly owned by KKR. Then Baldwin Group and Cat Group, they're merging. They'll become one of the largest insurance brokerage firms in the United States. Again, there's another consolidation taking place. This is really in the specialty and middle market insurance brokerage business. Then Goldman Sachs is active. They bought a management company to expand asset manager for $2 billion. This is one of the fastest growing segments in today's public investment landscape. And ProAmac is acquiring TC Transcontinental Packaging. This is one of the largest packaging companies in the United States. You may recall that they acquired International Paper's bag converting company a few years ago. And then Harbor Energy is buying Gulf for $3.2 billion. This is the Louisiana-based company involved in gas production and development and deep water production, if you will, in the U.S. Gulf of Mexico. Then we have a company called Vivicar, and that's buying Korea Oilfield Services. This is an integrated provider of energy transportation, storage, reuse, and remediation services. And then we have Boston Scientific is buying Penumbra for $15 billion in an all-cash and stock deal. It's one of the fastest growing fields of medical thrombosis and innovation. And then we have the last one we have is interesting. For all of those of you who've ever had a Nathan's hot dog, well, Nathan's hot dog has been acquired by a Chinese company called Smith Foods. For the acquisition was $450 million. So what happened was in 1916, an immigrant founded by the name of Nathan Hardwicker used a $300 loan to start the business. They were selling hot dogs in Coney Island for 5 cents a hot dog. So great hot dogs, and it's amazing as the world continues to turn. Now let's take a look at some other significant economic news taking place. NVIDIA, as you know, is one of our really strong bellwether companies. They've announced that the company will build 7 supercomputers for the Department of Energy. And that will be up, including over 100,000 chips made in the United States, which is good. And then Toyota pledged to build a $10 billion automobile plant in the United States. Outback Steakhouse, as you know, has been a problem for a long time. They're now going through its largest contraction. There's an investment group lining up to invest $2 billion to hopefully turn the company around. And again, they have a footprint of about 670 stores throughout the United States. And this is a really surprise here. The United States companies announced job cuts in October of 153,000 jobs. U.S. companies caught most jobs in October, more than 2 decades, as a result of reshaping business by use of artificial intelligence and cost-cutting acceleration. And you're going to see more of that going forward. Office Depot, which bought Office Max a number of years ago, what you're seeing happening now is they're going through a consolidation process. They closed another 100 stores and laid off 3,000 employees. Right now, most of what they sell is primarily online, so it's unfortunate that they're continuing to disappear. For all of you that know and heard of the Farmer's Almanac, it's been around for since about 208 years out of Maine. The publication ceased in December, so it's no longer around. It's one of the oldest publications in the United States. And Wendy's announced that they're shutting down 300 stores, and it's the largest fast food cutback we've seen in a long time. And that's taking place. And again, you see what's taking place in all the vertical markets as a result to the fast food business. The U.S. Postal Office raised rates again in the beginning of January, and that's because they have a $9 billion loss. United Healthcare just shut down 90 clinics across the country. And not only are they losing employees, this affects 50,000 local care patients across the country. And then San Francisco hotels, where a number of you live in the Bay Area, echoed a decline. They're selling 2 hotels, and it's called New Brand Holdings and Conversant Capital are partnering to acquire the Hilton Hotel in Union Square and also the Park 55 Hotel for $400 million. This is 75% below the value of the hotels. It's amazing. And then we have Papa John's is shifting away from company-owned stores, and they're selling 85 locations to franchisees. So they want to move away from owned to franchising and cut costs substantially. And they expect to open up another 52 by 2030 across the country. Microsoft is investing $17.5 billion in India. And the reason of this is the race is to build infrastructure in one of the world's fastest growing digital markets. I mean, it's just amazing how much growth is taking place in India. When we look at Pepsi Cola, Pepsi is axing a lot of sodas from its lineup, along with slashing prices and cost-cutting marathon. What they're trying to do basically is they agreed to slash 20% of its soda and snack lineup in the U.S. and cut costs substantially. This will affect things like Lay's, Cheetos, Doritos, and drinks such as Pepsi Cola and Mountain Dew. And Ford announced a couple of weeks ago what they're going to do. They're going to write off and take a $9.5 billion hit write down in the area of electric vehicle models. And what's happening now, they said that it will stop making the F-150 Lightning in its electric vehicle form as it stands today. Now, New Texas Instruments is in the process of starting a chip manufacturing wafer group for 300 millimeter wafers in Sherman, Texas. It'll be a $60 billion investment into a semiconductor manufacturing facility. This is incredible. We need more of this. The real key is, that a tremendous amount of our semiconductors come from Taiwan. And what we're trying to do is reduce that substantially because of certain issues that are taking place in the world with China. So the idea is to build more chip manufacturing capability in the United States so we can control our own destiny. And finally, Barnes & Noble, as you know, bought a book company a couple of months ago, is now said it's planning opening up 60 new stores around the country, which is good news because for those of you that still like to read a book. And then, of course, we have corporate bankruptcies, and this is where it surged. It surged in 2025 substantially since the Great Recession of 2010. We've seen only through November, 717 companies filed for bankruptcy. And this is 14% higher than in 2024. It's the highest level since 2010 when we were in a major recession. And then for those of you familiar with Saks Global, high-end store chain, basically they're filing bankruptcy. Saks Fifth Avenue, Neiman Marcus, and Berghoff Goodman. The company is in the process of securing a $1.75 billion financing package to hopefully keep the stores open while they go through the bankruptcy process. And finally, Popeyes, which is a major, chicken franchise company from the Southeast. Popeyes announced that they filed bankruptcy and they're in the process of closing a lot of non-profitable stores. So that kind of gives you a thumbnail sketch of what's taking place in the economy. And these are some credits for some of the people involved with our group. So what I'd like to do now is unmute everybody, and then we're going to open up with Q&A. But the first thing I'd like to do is have Kathy give us her insight into what she sees taking place in the marketplace in the real estate sector. So, Robert, we'll go ahead and open up the program.